we're going to focus right now on the municipal bond market. Take a look at this chart. Prices for municipal bond securities have taken a nosedive since last December. Prices have fallen off about 10% since hitting a high at the end of August. Of course, a lot of big names have been out there offering their opinions on the muni bond market. And joining me now is someone very close to this topic. Her name is Suzanne Shank. She's president and CEO of Siebert Brandford Shank. It's a municipal bond investment banking firm, and Ms. Shank's firm has 22 offices across the U.S., managing over $700 billion in deals for state and local governments. Suzanne, thanks so much. Great to have you here on this Tuesday. Let's start. I do want to get to what is happening in the municipal market, but I also think your firm is a very interesting one, and it's a nice opportunity to highlight the fact or spotlight minority-owned firms, and your firm has a unique story.
Very unique. We started the firm in 1996. We're majority minority and majority women owned, and we've grown dramatically over that time frame, making it into the top 10 in 2010. We were 8th for senior managers of negotiated bonds.
All right, so you're obviously very close to what is happening in the municipal bond market. There's a lot of fear out there, and we have many people opining on the municipal bond market who perhaps aren't as close as you are to it. Of course, we've got Meredith Whitney. She was on television just last week saying she expects accelerated outflows from muni bond markets as state finances deteriorate in the next 6 months. That was an exact quote from her. She's also forecasts up to 100 significant muni bond defaults this year. But then you've got your Bill Grosses, saying municipal bankruptcies will be at a lower level, and I don't know that he thinks that there are going to be any particular defaults. So what's your take on this, and where do you fall out in between those two?
Well, in terms of the outflows from mutual funds, I think we're seeing a self-fulfilling prophecy. If we talk about and scare the marketplace as to the volume of defaults, yes, investors are going to get skittish and pull their money out. Rates are going to rise, prices are going to drop. That's what we're seeing now. I disagree, though, that there are going to be widespread municipal defaults. First of all, since 1930, there have been no state defaults. In the corporate arena, there have probably been about 2,000. It's a very different marketplace. Paying debt is generally a first budget obligation. We can raise taxes to pay debt and compromise services if municipalities have to.
Now, what's interesting is, we started off looking at that price chart. The muni bond market was on a tear. There was heavy issuance.
Yes.
There was also a program supplemented by the government, the Build America Bonds program. Now, clearly that has been taken away, but just in a series of just a few months, we have seen a complete turnaround in terms of sentiment related to this market, and I can see why, sometimes when you see that quick of a reaction, it's not really based on fundamentals so much. It's
not, and we saw rates go up also because we had a huge amount of supply at year-end because of Build America bonds expiring. But what's not taking into account here in terms of the fundamentals are that governors and mayors are making those tough decisions. We saw the governor of Illinois raise state income taxes by 2/3. That's huge. We're seeing the mayor of Atlanta tackle their pension system. We see all over the country these difficult decisions being made, and they have been being made for the last several years. As soon as the crisis struck, budgets have been cut dramatically.
Okay, tell me what areas are you avoiding? Certainly not all municipalities are created equal. Not all municipal bonds are created equal. What are you telling investors? And when you are talking about potentially underwriting a deal, what are you hearing from municipalities?
Well, credit spreads have widened dramatically since the fiscal crisis. In 2007, the spread between a AAA and a BBB was about 30 basis points. It went to a high in January of 2009 of 260 basis points. Now it's probably in the 150 range. We need issuers to understand that it costs a little more to do lower rated credits, and investors also need to know that. So we're working very hard on disclosure. Investors need time to review documentation, and we need to get the information out there. We've been doing a lot more of investor roadshows and really providing information as to the fundamentals of any particular credit.
In terms of issuance right now, I mean, this is an important part of liquidity for many municipalities. How far off do you expect issuance to drop? We have about 10 seconds. I apologize.
We expect it to drop this year, not only because of the rising rates, but with Babs not being here. There was a rush to market in the last quarter of the year. Really, a lot of the deals were done that needed to be done in the first quarter. So we're going to see more volume towards the end of the year, but I just think it's going to be pretty slow and not a whole lot to choose from.
All right, Suzanne, thanks so much for joining us on this Tuesday. That was Suzanne Shank, President and CEO of Siebert Brandford Shank.